What's up, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to be talking about ServiceNow, ticker NOW. So this is another stock I got some requests to do an analysis on, and this one was very interesting. Not what I was expecting, mainly because of the valuation. So let's get into ServiceNow and see if this is a good stock to buy at the moment. So right off the bat, the stock is $463 a share. It peaked last November at $692, and this market cap is a $94 billion company. Now, the first thing we're going to look at for my checklist is the revenue and net income. So revenue is doing very good, right? From 2010, they started off with a mere $16 million of revenue for the quarter. Meanwhile, in the most recent quarter, they did $1.9 billion of revenue in one quarter. So phenomenal job growing revenue. As for net income, well, still good, but not as good. We're at $150 million of net income for the most recent quarter. So not bad, right? A lot of similar companies that are in this cloud enterprise software space, they're a lot of times they're losing money. So at least this company is making money. And in the most recent quarter, we saw $150 million of net income. So both of those will get a check. Now, number 3 on my list is the price to earnings, the forward price to earnings for this year, healthy or not? This was one of the most interesting parts of this analysis, because if we take a look at the PE ratio, right now it's trading at a PE of 290. And that's not even as bad as it gets. Let's look at the history of this stock's PE ratio. In late 2020, this stock traded up to 930, and for the longest time, it traded anywhere from 500 to 700. So if we go further back, I've never seen this before in my life. In 2019, it somehow hit a 13,000 PE ratio. I don't know how that's possible, but they made it happen. So that was pretty interesting there. But the real usefulness of this is going to be looking at, okay, in mid-2020, the lowest it got was a PE ratio of 83. And that was right at the giant crash of the pandemic, at the very lows. Right around that time, it was at an 83. Then it went up to a 930, and now we're sitting at a 290. So really, by historical standards, this stock is trading at a discount to where it normally trades. So this was very tough for me because I gave it a yes, but so the other thing to look into here is the forward PE, because the forward PE, as you're going to see here, it says it's the 45, but when you actually run the numbers updated with today's current price of $464 a share, and they're expected to do $11.31 of EPS for the following year, that comes to a 41. Now, as you can see here, I don't use this very often, but if you look at my criteria, it says average EPS growth percentage should be at least a half of the forward PE. I don't normally pay too much attention to that metric because I normally don't have to. It's normally pretty, black and white of is it a good PE ratio or is it not? This one was very tough because this one is literally right on the edge. So let's say, so it's somewhere between a 41, but like right here, it says it's a forward PE of 45, right? Well, if you do the calculation, so they're growing revenue 22%, pretty similar things with EPS. They're growing right around 22%. So it's literally right on the line for if this is a healthy PE ratio or not, because they're growing 22%, but the PE ratio is a 41 right now. So, I mean, the thing, I keep thinking back to what Warren Buffett says, where Warren Buffett really only buys, I know he's not a huge growth investor, but he goes back to value investing and looking for stocks that traded at a PE ratio of around a 15, right? Like a 10 to a 15. So when you're talking about a 41 PE ratio, this is close to 4 times what the average value stock should be bought at, right? So you have to think, okay, is that growth really that strong and that sustainable where this is going to make sense? To me, this looks like an example of one of those stocks where they have a phenomenal business model and a huge future ahead of them. It looks like they're doing the right thing. The problem is the valuation is just caught up too high in it. So I would say this valuation's too high for, even though this company is growing at 20+%, I think if you're paying a P ratio of 40 plus, I don't think it's a good deal. Now, let's take a look at Tesla. Okay, Tesla's a good comparison. Tesla's growing at what? Somewhere around 30% a year, probably maybe less now, but let's see. What is Tesla expected to grow at? About 25 or 30%. But Tesla is another company that trades at a trailing PE ratio of 55. Okay, so they're growing 27 to 29%. Okay. 27 to 29% of growth with a 53 trailing PE ratio and a 29 forward PE ratio. So you're getting more growth with Tesla and paying a dramatically lower valuation. So in that sense, Tesla looks like the much better deal. So ServiceNow, it's a company that looks like all the future growth is pretty much priced in. Okay, it's like those other companies that got caught up last year, like the Teladoc Health or the DraftKings or these other companies that they're growing 30%. They might even grow 40%, 50% in a year. But when they're trading at PE, Shopify is another good example. When they trade at PE ratios in the hundreds, there's no money to be made. Like I can say, okay, yeah, this company's gonna 5x their net income over the next however many years. But if that's all priced in and you're paying 100 times, 150 times earnings, there's no money to be made because you're already buying the company at what it's valued at 10 years in the future. So there's no money to be made. You're just going to break even. That would be what makes sense. So if you could get this company at, I don't know, maybe 20 to 25 times earnings, that might be a deal. So if this stock trades at, let's say, probably like $300, maybe $300, somewhere around there, $250 to $300, I would say it's maybe then it might make sense to invest, but not right anywhere around 460, I would say no. So let's keep going. Number 4, are they innovative? How I said, yeah, they have artificial intelligence integrated into their software. They're working with the cloud. I would consider this innovative. Number 5, it's a growing industry. If you watch my previous video, we talked about AI software. The industry is expected to grow, I believe, 36 or 37% a year for the next 7 years. So they're in a perfect industry. Return on invested capital is not very good. If we want to look here, let's go back to ServiceNow. We will see that return on invested capital is only 2%. So doesn't look too good there. Healthy cash flow. This was another one where it's surprisingly a little bit better than I was expecting. So if we look at cash flow, they are doing a good job, paying back debt. Operating cash flow has more than doubled over the last 3 years. That's phenomenal. And they're investing a very heavy percentage of their income, like probably 70-80% is being invested. And you can see financing income, a lot is coming out, right? A lot is coming out to pay debt. So that's also a good sign. Free cash flow has more than, well, now we're approaching a 3x in free cash flow in the last 3 years. So it makes sense. They're a very fast growing company. But the problem is when you pay those high PE ratios like this, you're not on the right side of the bet because you're pricing in everything that's going to happen and things are not in your favor. That's really because it's pretty much best case scenario. If they execute firing on all cylinders, then you're paying a fair value. You're not getting a deal. So if they slip up on one thing, or their growth over the next 5 years comes down by 5%, and there's a slight decrease in how much they grow, then that valuation is gonna go down. So things are just not in your favor when you're paying a PE ratio of 100 plus. Diverse revenue streams, no, they make their money through subscription fees by selling their software. Number 9, is the equity growing? Yes, it is. So they're doing a great job running the business, but besides for the return on invested capital, that's the only thing that was weak. Everything else, the equity, again, it's more than doubled in the last 3 years. So they've done good with things like that financially. No, equity is not over 15% of the market cap. This is the reason I put things like this in there, because it checks it to make sure that the valuation is not way out of whack. And in this case, it is way out of whack because they have $5 billion of equity, but the market cap's at 94 billion. You're paying $94 billion for $5 billion of equity plus a company that does $400 to $500 million a year in net income. So think about that. You're gonna have to wait. It would take a century to make your money back on this if you bought this business. You see, it doesn't make sense. Number 11, is the share count decreasing? No, it's not. If we look at the number of shares, we will find that it is rising, just like a lot of other similar companies. It's gone from 117 million in 2012 to now 200 million. So it is what it is. Number 12, are insiders or big money interested? No. Some interesting things I found here. Both insiders, so here's the website, here's the CEO, but both insiders and hedge funds have been selling a lot more than they've been buying over the last 2 years, I want to say. So things are just not in this stock's favor. I think the stock is going to fall. I mean, again, how I said, if it was $300, maybe then it's worth investing in, but it's just at these prices, I don't see it. Respectable management, this one I don't have a strong opinion on. I don't know. I don't really even know about this one. I put yes because, again, the business is growing phenomenally. Financially, they're healthy, besides for the ROI. But the valuation's just not there. So I guess you can give that one a yes. Number 14, cash more than average annual income. No, I believe they have what, 1.4, no, 4, I'm sorry, 4.2 billion of cash, and in the most recent year they did 325 million. So I'm sorry, I messed this up. That's a yes. So this is a 9. Number 15, no dividend. Number 16, not 20 years old. They actually missed it by 1 year. Sorry, next year they'll hit that one. So a 9 out of 16, I would not count this as a buy. And yeah, great company, I guess, but the valuation's not there. It has long ways to go before this is at a fair value or an undervalued stock. So thank you for watching. I'll see you guys in the next video.